pretty good couple years in the market. So 2023, 2024 were both good for the market. One of the things I emphasized was the size of fiscal deficits during that time, which were generally stimulative and all else being equal, positive for markets in a nominal sense, as well as GDP running nominally on the hot side. And when we enter this year, some of that is slowly changing. So there's potentially fewer upside surprises in store, more downside uncertainty, things like tariffs, things like tempting to tackle the fiscal deficit in pretty kind of shock and awe ways at kind of the start of the administration. And so I think it's natural, especially because equities were priced at a pretty high valuation. Now, in this whole kind of decade-long period, they've been on average a little bit more highly priced than like very long-term averages. But even given this kind of cyclical ebb and flow of valuations, equity markets were a lot more highly valued than, for example, they were in the beginning of Trump's first term, if we use like a comparable baseline. So the combination of pretty high valuations, a lot of global capital all stuffed into U.S. markets, overweight U.S. and especially overweight U.S. large cap growth has been very much the consensus play that keeps winning. And I think for the first time in a while, there are some challenges to that. I think the sell-off is natural. Partially, how deep it has to go will depend on policy decisions. There tends to be a somewhat feedback loop there. So, don't really mind 5% corrections. When you start getting into 10% and people aren't really sure where the end game is, they start making noise and you see kind of rhetoric shift around that. And, one of the ways to mitigate it was to have a fairly diversified portfolio. So for a long time, having international exposure was kind of an anchor on a portfolio, whereas in this particular sell-off, international equities on average did better. It's kind of early rotation potential, as well as owning other types of assets. I mean, gold's, poking around its all-time highs. It's kind of funny because when I look at a portfolio, it's like nothing to write home about, kind of a week, month-long period or more. But the sentiment on social media, from what I've seen, has been pretty kind of surprised. And I think it's mainly because the things that underperform the most tend to be the consensus. So some of the large cap growth underperformed the S&P, and then the S&P underperformed global, and that just kind of messed up a lot of people's positioning. One of the things I have been writing about for a while is the structural U.S. trade deficits and why they do matter. And I've pointed out that that's pretty tied at the hip with the dollar being the reserve currency. So basically, compared to most other currencies, other than maybe one or two other sizable ones, there's a lot of countries that want to hold U.S. assets or U.S. currency directly. It's basically the biggest, most saleable network effect for money in the world at the current time. And so a lot of international contracts and trade are priced in dollars. A lot of financing is priced in dollars. So a lot of countries and corporations have dollar-denominated debt. And so for most currencies, they tend to trade on things like interest rate differentials, trade balance differentials, things like that. There's kind of this like control loop that happens if a currency gets too expensive, too cheap. The dollar is kind of different because it has this more structural bid on top of the normal things like interest rate differentials and trade. Because basically the whole world needs dollars. And the way that they get dollars is basically we just pour them out like trillions of dollars over time, generally through structural trade deficits. And the mechanism is that because so many people hold it, they kind of inflate the value of the dollar. So our import strength gets stronger, and our ability to export lower margin things shrinks. And so we can be good at tech, healthcare, and finance, but it's hard to be good at manufacturing in that environment. And when you run that policy for decades, you kind of hit more critical parts. You get more deindustrialization, you get rising populist politics and changes on the electoral map. So I start from the viewpoint that the trade deficits do matter, and it's not surprising to see that increasingly become a political touch point. But I do think that the shock and awe tariff policy is likely to have backlash. I think we're already seeing that. And the other thing that I generally point to is if you kind of look at the administration, there's obviously different actors in it. One of the ways to help at least understand the somewhat intellectual framework that they're doing is Stephen Miran wrote a paper in November 2024 that talked about realigning global trade. It's kind of like the more intellectual, like if you were to steelman what they're trying to do, that's the paper to read. So I think that tariffs can impact in the very short term. You can just flip a switch and tariffs are on, whereas supply chains take a very long time, especially at scale, to move. It's easy to kind of sit in New York or sit in Washington and kind of look at everything, numbers on a chart. But when you actually are moving facilities, moving logistics hubs and things like that, that's actually a really time-consuming thing. So in the near term, it's likely to be inflationary and disruptive. Longer term, the best case scenario is it can kind of signal a priority shift. In that paper, The Economist covers not just the tariff side, but also ironically trying to discourage the rest of the world from stashing all their excess value in U.S. financial assets and overvaluing the dollar because of that. So it's kind of like this 1-2 punch of trying to make imports more expensive and then also trying to discourage excess capital recycling. In the context of understanding some of the voices in the administration to see what they're at least trying to do, I get that. But yeah, I would generally agree with the consensus view that tariffs are more likely to slow down or impair an economy than help it. it's a potential turning point, and I started writing about that last year before all the tariff stuff came into effect. My initial catalyst was the US was entering a rate cutting cycle, and so it'd be the first window since 2019 that could be a catalyst for some of those capital outflows. Now, 2019 didn't really end up doing that because, within a year, COVID hit and the big, US network effect tech stocks, really benefited from that. And also the US did more fiscal and kind of came out a little bit more explosively than the rest of the world, while China and other places were still kind of in contraction mode. And so that didn't work out last time. The area of my portfolio that has been more challenging has been expecting a little bit more of a rotation earlier. So I've been early on that trade. I'm always a little bit cautious to say, okay, this is the big rotation, because I'm mindful of the difficulty of making that call. But I do continue to hold the view that it's more likely than not that this is early sign of a rotation, because there is the initial rate cutting period, all the tariff uncertainty, the fact that I've been emphasizing China because they've been in a balance sheet recession for a while. That they're trying to deflate their property market and kind of deflate bubbles there in kind of a gradual pace. But last year they started to hit certain pain points on Chinese social media. It was starting to come up, and then they were starting to hit red lines in the equity market where their kind of priorities shifted. And so my view was that they weren't going to come out with some sort of hyper stimulus, but that they're going to come out with a series of smaller ones whenever they keep bouncing into these red lines, and that they're starting to put a floor under things rather than a ceiling over things. And so when we see European fiscal opening up a little bit, Chinese consumer stimulus opening up a little bit, while at the same time the US is, still being fairly tight with monetary policy, while also around the margins trying to contract fiscal, and then you add tariffs, it's a pretty good recipe for the rest of the world, especially because there's also that big valuation differential and everybody is on one side of the boat, stuffed overweight into US markets. The issue is that the vast majority of the spending is these really big buckets that are hard to cut. So Social Security, Medicare, interest expense, defense spending, veterans benefits. And if you look at, even for example, back in like the Paul Ryan Republican era, so that, the past decade, they were trying to reform Social Security, Medicare, raise retirement age, trim things, potentially privatize some of it. Whereas in kind of the Trump version of the Republican Party, like if you look at 2024 GOP platform, Promise 24 is don't cut Social Security or Medicare and don't raise the retirement age, which is normally what you see in a say, a Democratic platform historically. That's where the biggest stuff is. So the optics are the idea that there's a lot of government waste, a lot of employees, and you can start trimming that. And while you can rack up a lot of these like optical wins or dramas, depending on what side of any given issue you are, it doesn't really eat into the biggest things on the pie chart. Probably the only area that is big enough, discretionary speaking, is defense. But then the issue there is every single congressperson who has some program in their jurisdiction is going to fight tooth and nail to keep it. You have to go through all that, let alone the fact that outside of defense and outside of all those big transfer programs, we look at like FAA, Department of Education, all those are like little tiny slices on the pie chart compared to those really big things. So I haven't made any major decisions, but the parts of the portfolio that are working or not working are certainly changing. So it used to be that US growth stocks were great. Obviously, Bitcoin and MicroStrategy were great. The gold slice has been, I purposely was kind of a bond bear and wanted some of that slice in gold, which has been a good decision. The part that I mentioned before, the anchor, has been the international equities, and to a lesser extent, the US kind of dividend stocks. The US stocks are doing pretty good, but they're not the Mag 7, for example. And the recent rotation is basically saying that, there might be some current wake up on overvaluation among US growth and a little bit of a wake up on opportunities elsewhere. And one thing I like to point out is that it's not just tech. Everybody focuses on, obviously, the tech is popular and expensive, but I've been highlighting the fact that Costco has been trading at 60 times earnings, and it's a 4 or 5 decade old retailer. It's a great company. Their growth numbers are good. I'm very bullish on the underlying company, just not at 60 times earnings. And there's actually a lot of things like that are just priced, maybe not that extreme, but there's a lot of things that are just priced pretty expensively. And so I think we're entering the period where that starts to matter. But because I have been concerned for that for a while, I'm already positioned for some of that. And the caveat that is that during, where only US growth mattered, the equity side had a little bit of an anchor on it, which lately has turned into a little bit of a booster. And so it's not that I'm making changes, it's that I'm noting things that are happening. And I think my biggest question now is to see if this has follow through, because I mentioned that the rotation has been a very hard call to make. I think this has legs to it, but I do want to see continued evidence that it has legs to it. I think I would look for areas of overvaluation, things that you're not comfortable with, and reduce those overweight positions. The S&P 500 is very concentrated. The NASDAQ 100 is very concentrated. I do still think there's pockets of value in the U.S., just generally not in the big U.S. growth. And I also differentiate on a company by company basis. Like Apple is a case that I've not been bullish on that for a while just because it's kind of a value stock that's priced like a growth stock. That's been the challenge. When you look internationally, there are pockets, and it's funny because some of them have the same issues. Like Brazil has had some friction lately because of its budget deficits, but the budget deficits have not really been that different than the US. And it's just a matter of whether or not there's external demand for the currency and the assets or not. I've been less bearish on Brazil than it seems like the average consensus investor was, especially given some of the valuations and opportunities there. Like I said, I have been bullish on China with the caveat that there's a small percentage that something geopolitically happens and it entirely messes up that side of the portfolio. Kind of like what we saw with Russia, for example. And so it's like, 90% chance. I was like, these are undervalued, super cheap. They actually became more shareholder friendly. So for some of the big Chinese tech stocks were like initiating dividends or buying back shares when they were super cheaply priced. So that's kind of a change in that space. So more shareholder friendly policies. I do think that there are a lot of pockets out there that are quite interesting. And Europe, I have historically found a little bit less compelling, but when it's been dead money for a while and you do have marginal fiscal waking up, it's nice to own some of that. At least compared to American dividend stocks, you can look around and say, are there ways I can diversify my kind of value or dividend exposure?